Hey guys, all content discussed is due diligence gathered with aim at better understanding the nature of the current market in anticipation of the greatest squeeze in financial history. Let's dive in. So I made it through the worst storm of my life fine and dandy, and I am ready to start pumping out new content. Where to even begin on this awful day? Let's just cover what happened first and branch out from there. Stocks turned real bearish, dipping to the lowest they have been since November of 2020 after more Fed officials displayed a hawkish tone. The S&P 500 dropped 3% and other benchmarks had precipitous falls as well. What exactly happened to bring about such a dramatic fall, especially after stocks ran up yesterday with news that England would begin purchasing bonds in an effort to help steady its financial markets and cratering British pound? Well, it was Cleveland's Fed President Loretta Mester who, appearing on CNBC, said that the current interest rates are not restrictive enough, and that there is more to be done to bring down inflation as a whole. This statement not only showed a hawkish Fed, but one that thinks these current interest rate levels are nothing to scoff at. They view them as too little, which makes investors panic because it becomes a question of perspective. If the Fed think this isn't bad, how far will they go? All of a sudden, people are now realizing just how far the Fed will be willing to go to tame inflation, and they are willing to erase trillions of dollars, years of stock gains if it's necessary without batting an eye. These market tumblings are projected by the media as a crisis of itself, when it really isn't. This isn't a crisis of losses in market valuation, this is a crisis of confidence. Again, one of the most annoying remarks in markets is that things are priced in. We have seen how for months, bad news was met with bullish runs non-stop. This was because investor psychology was set on a false sense of confidence that regardless what happened, the Fed would ensure markets continue gaining, as was demonstrated they did in 2020. Well, as we have been saying, this is no longer the way of doing things, and investors are learning in the worst of ways how wrong they were. The perma bulls are still looking for any excuse to remain positive in their market outlooks, but after taking some time today to quickly look at some of the latest figures, let me be the one to break it to you guys that the economic activity of the United States government is looking disastrous, disappointing and weak. Before we dig into this, let me just remind you guys that even with any run that could happen, as the market might still be suffering from overconfidence, will be met by a disastrous fall eventually. Markets could signal that this bad economic activity is accounted for in the current valuation, but it's not even close, so let's look at the figures and paint the grim picture. Inflation-adjusted gross domestic income, which is one of the government's main measures of economic activity, rose by just 0.1% annualized rate in the second quarter of this year. But this is still growth. Why would this be seen as bad at all? Well, because this still represents a very sharp downward revision from the previously reported 1.4% gain. Going from 1.4 to 0.1 is beyond bad. This is catastrophic levels of gross domestic income, especially when inflation adjusted as they are. This is hide your money in your mattress type of economic data that for some reason the corporate media isn't making a big deal out of. I guess they are working hard to prevent data from proving true to the fact that we are in a recession already, but we ain't done. The average of real gross domestic product and GDI, which is an equally weighted supplemental measure of economic activity, actually decreased 0.3% in the second quarter after falling 0.4% in the first quarter, bringing us down 0.7% so far into the year. These figures are important to the National Bureau of Economic Research Business Cycle Dating Committee, because they will be used to average and range other variables in the economy to make a recession call. We will see if the government will be willing to call things what they are instead of tiptoeing around technicalities in the dictionary as to what a recession really is. Again, even with these numbers, don't look surprised if the markets bounce. The amount of arrogance in market participants to think this means anything positive worthy of buying the dip is still frustratingly high, and doing so can and will most likely result in serious losses for those parting in it. Now, let's move the topic of discussion to our favorite overlords who are soon to own everything in the world, BlackRock. According to legitimate sources and press releases, BlackRock threatened to halt trading in certain funds with intentions of watching their own pension fund clients. BlackRock told clients that were using its liability-driven investing strategies that they would freeze funds more at risk of assets being exhausted. In other words, clients weren't allowed to buy or sell at all. What was hilarious in this is that clients were coming forth to the press about this in numbers while BlackRock has been in full denial about it ever since this began to make headlines. Must be great being able to deny what you do without consequences. And this is happening because of one thing that, though covered in the media, it's not being portrayed with any significant honesty. The truth is, ladies and gentlemen, that the British pound has blown up. After news that the Prime Minister's approach towards tax cuts were significantly unfunded, it spooked fear into investors in a panic, where they saw their own currency reach a record low against the dollar. The Prime Minister apparently prides herself on dismissing the advice of orthodox economists, and that has resulted in arrogant decision-making where now her actions have directly led to British currency being seen as a joke, as unstable, as weak and untrustworthy. I don't know if you guys knew this, but the British pound was something that could be counted as being more valuable than the dollar. It will be hard to reverse course for the country, but they are in a very serious predicament. Britain is in a full-blown economic crisis right now, and this one seems to be more about their own confidence in themselves than anything else. I think the death of Queen Elizabeth also being so recent has in many ways affected the psychology of market participants in the country as a whole. It will be interesting to see how they continue to crawl, because their neighbors in Europe are not looking too good. In fact, as bad as it is, the UK right now looks like a dream out of a Disney story compared to the hardships Europe is enduring and the even worse future that it awaits it. Some politicians in countries in Europe aren't even worried about the economies underperforming. They are literally warning that the current energy crisis they are enduring will completely annihilate their economies. Slovakia's prime minister says that soaring electricity costs have left his country on the brink of collapsing completely. With recent news that Russia was mobilizing more troops to send to Ukraine, people are now understanding the full scope of effects that this means for Europe. This full-scale invasion of Ukraine will 100% kill economies across Europe, not just Slovakia. So let's speak economic outlook for Europe as it stands. Right now, Europe is thinking short-term. They are hyper-focused on whether their plans are enough to get them through this year's winter. Fears of social unrest will break out this winter are growing. Even ion countries like France, which have been working hard to protect consumers and businesses from rising energy costs. They have been one of the better examples of insulating their own citizens from price increases. The more this crisis drags on, the more difficult the political conflicts will get within and between countries. Europe has been sitting pretty depending on energy exportation from their greatest rival and threat, and now their layback position regarding these affairs are going to quickly bite them hard. With limited energy supply and excess demand, European and the markets can expect high prices to be all around in 2023. The idea that things will begin to ease next year are unrealistic. Europe is in a dire position right now where we could see civil unrest, civil wars and worsening relationships between each other. This instability will not only ensure the weakening of that region, but the complete uncoupling of the entire world's economy as a whole. Regardless of our own ability to produce our own energy, them performing bad puts America at great risks in all fronts. This isn't even accounting how well this could play to Russia's plans of further expansions and China's committed will for reunification of Taiwan at whatever costs are necessary. So again, Europe is dealing with an energy crisis literally month by month. Civil unrest is growing and countries are already warning they are on the brink of economically collapsing if things don't improve rapidly overnight. The United States economy will not be a safe haven for anyone at all, for not only are we exposed financially to Europe, but we also have significant problems in our output that also sets us up on a dark path moving forward. Let's talk a bit more about housing in the US, because officials have been teasing a price correction of sorts, but they are greatly undermining the severity of it. So as you know, the pandemic housing boom saw US home prices soar 42%. A couple days ago we talked about how home prices are beginning to cool off, but that they are still relatively high at the moment. This is true to a fact, but after reading some fresh economic data results, I am now more bearish than even in the housing market, and I think you will be too after I share what I learned. Heading forward, there is a serious possibility that the gains we made since 2020 are going to be erased completely. Readings for July came in 0.24% below its June reading, which marked the first month-over-month decline in home prices since 2012. This is key because it indicates a trajectory shift. The decline was bigger than it first appeared to, and the reason is actually something we have been talking about for months. I don't know how long you guys have been listening to my videos, but if you have been a fan since last year, you know we talked high and mighty about Zillow and other similar corporations. We talked about how they tend to buy housing, using robust algorithms that calculate and predict where people are likely to move and live so that they can anticipate where to buy to make higher profits. For months, we talked about this phenomenon, covering personal stories of what happened to the overall strategic plans of Wall Street to use these companies to capitalize and own all the housing in the United States completely eventually. Well, there have been problems with their agenda, as the recession has gotten worse over time. The problem with Zillow and similar corporations is that the engineers writing the code and businessman signing where to buy are just out of touch. The people in these jobs tend to be paid very well, and to them increasing the price of renting in some apartment complex by 50% is not a big deal because they themselves live in another tax bracket. They don't see how someone cannot afford $400 extra a year to live in some vacancy, and any struggles by people are assumed to be just poor people being unwilling to work. This is fundamental to understanding the housing correction. Because these people are out of touch, they have not been doing a good job at adapting to the quick economic changes happening across the country. Because their perspective is set on maximizing revenue regardless of wage stagnation, they are slowly increasing the size of the housing bubble we are in. Like I said last year, the housing bubble is set to last a bit longer than the stock market because demand for housing was still high. New reports are showing that home sales are beginning to decrease and would-be home buyers are pulling out of contracts. With interest rates going up, who wants to buy a house and pay 3 times the actual home price in just interest fees? This is the worst time to buy housing, but Zillow and other corporations are not attuned to this reality. Still, from their lavish high-class apartments, they work from home looking for ways to increase prices, growing the bubble. No, we are watching people pull out. So what happens when home prices are too high but there is no demand? You might think that pricing will simply drop to proportional levels so that supply and demand can be at the perfect point, but this will not be the case at all. You see, the Fed today said that rates are not high. That in fact, they don't even think they are even close to being as high as they could be. Energy and other economic measures are growing inflation, including mortgages. If the Fed, the policymakers, think interest rates are not high enough, this means they will most likely continue raising them into next year and so on. This means that even less people will be buying houses, which means Zillow and therefore Wall Street are going to have a serious problem because they are not producing money as they used to. This could pan out in many different ways, but they all end with the housing market imploding on itself. We are seeing people move in together more and more, staying at home to live with mom and dad, and even begin to look to move out of the country. Recent news showed that the majority of people looking at housing Mexico were Americans, giving you a bit of irony as to how much things are changing and how quickly they are too. The housing in America will collapse on its own because it was bought out in rush by a single entity, Wall Street, and they're subservient, and that does not allow it to have the balance and stability of a good market. I am looking into the real estate bubble now more than ever because, as I said before, I think it is the one variable which will break the economy and send us all into peril in a depression. Nothing new came from AMC or GameStop. I continue to DRS my GME shares. What did happen was that GameStop had the lowest volume to date yesterday, which could imply that we could be going for a run in coming weeks, but again, at this point in time, who knows? Regardless of the runs, we are zen and will continue to remain zen in this channel. We are not here for little runs, we are here for MOAS. Continue doing what is best for you, continue holding if that's good or buying if you see it fit. I am here until the moon or to zero in this investment. Before I leave you guys, I want to thank the hundreds of kind individuals who wished me good luck and prayers. I am good and set to continue making great meaningful new content for you all. Thank you for staying with me and watching some of my older videos while I was gone. With that said, I hope you guys have a magnificent rest of your day. Join the Discord in the description and to the moon.